Good morning. Today is Monday, January 9th, 2023. I'm Joe Terrell, president of Terrell & Company, private wealth managers headquartered in St. Louis, Missouri. This is our first video update of the year about our thoughts on the economy as well as investment markets. And with that said, let's get right to it. The economic outlook is very clouded right now because we just don't have an idea yet of how the consumer around the world is going to respond to higher interest rates and higher inflation. But for the moment, we are still bullish on the world economy. China is reopening, which should be a little bit of a stimulus. And so far in the world's largest economy, which is the United States, we see no indication that the consumer is cutting back on their spending. Businesses, which are about 1/3 of overall spending in the United States, are more cautious, but they're not 100% cutting their budgets dramatically like they do in times of economic distress. So we remain very constructive about world economies. That's not to say that we won't maybe have a recession enter later this year or even early next year. But for the moment, the economies around the world look okay. With that said, switching gears to investment markets, those of you that have followed us for quite some time and continue to follow us know we've been bearish for maybe the last 18 months, and even with prices being dramatically lower today than they were 18 months ago, we're still very cautious. To us, it appears that investors around the world are hoping that we're going to get investment markets back to the point where they start going up again and the bull market returns, and it's what we internally call they want the party to start again. And we think it's different this time, and that's not going to happen, even though major hedge funds and people all around the world are hoping that it will. Their hopes are inflation's going to go back down, the Federal Reserve will cut interest rates, central bankers around the world will go back to being very accommodative with money printing, and therefore the party can start all over again, and investment markets will do nothing but go straight up, and boy, we're all going to make money. What do we have to do to get that party started again? But at Terrell & Company, we think it's different, and I thought I would take a moment to explain what's different this time. And let's go to the question of central banks. Central bankers for the last 12 years have been highly accommodative with printing all the money that the economy needed, as well as holding interest rates at an incredibly low rate. That's no longer the case right now. It's different. Most central bankers are being very tight in their monetary approach. In the United States, of course, the Fed is tightening. They're not easing monetary conditions. And we believe the Fed when they say this can go on for another year to 18 months, and we have no intention of quote unquote pivoting and going back to an easy monetary position. The second thing that we talk about that's different this time is inflation. We went through a period around the world where inflation was very dormant for the last 10 years. That's certainly not the case now. Inflation now is at 40 and 50-year record highs. So that is different. The economy around the world, the economy had been very strong in the last 10 years. And in the United States in particular, excellent. That's no longer the case. The economy's okay right now, but concerns by people about the high probability that maybe later we're going to have a recession is very much on the front table of everybody. One of the other things is financing. We see now with the cryptocurrency and some of these issues how people that wanted to get financing for very aggressive projects or real estate investments and leveraging pension plans, this type of financing was very abundant and very easy to get. That's all gone. Now we're actually having somewhat of a problem with people getting financing. One of the things that we point out about this is Blackstone's real estate fund. Blackstone's private equity real estate fund has redemptions. They can't pay the redemptions. They are making a special financing deal with California University retirement system to provide them financing at effectively what's 11.25% floor and maybe higher. So a lot of the liquidity that we've seen around the world, a lot of the things that were going on that were driving investment prices higher, that's all changed right now, and it is different this time. Interest rates themselves are the biggest indication to this. We went through a period where interest rates were at 250-year lows. The interest was, money was free. If anything, banks were turning away deposits because the expense from a regulatory standpoint of having the deposits wasn't worth it, even though they were paying nothing for the deposits. That's all gone. We're back now to a more normal, it's got a ways to go, but we're back now to a more normal interest rate environment where the cost of money is beginning to come closer to where inflation's at in order that it could provide a real rate of return. So with that said, markets, stock markets, bond markets, they continue to struggle a little bit. We're back and forth with markets being down. Late last week we had some nice rallies, but at Terrell & Company we believe at the end of the day, at least in this first part, 3 months, 6 months of the year, we're going to have more downs than we do ups. And we continue to be very cautious about making new commitments, unless, of course, we do get even cheaper prices for investments across the board. The technology market has been annihilated in the last 12 months. Most of the FANG stocks, Facebook, Apple, Amazon, Netflix, Tesla, you name it, they're all down dramatically, 40, 50, 60, 75%. Some of the smaller technology stocks are down even more than that. So that doesn't necessarily mean just because the price of those stocks are down that much they should be bought or that we intend to buy them. No, it always comes back to the fundamentals. How much is this company earning in real cash? How much are their expenses? How much are their capital expenditures? What's going to be left that is free cash flow? free cash flow allows them to buy back stocks, increase dividends, and otherwise do positive business decisions. So we are still cautious, and even though prices, and we've been correct, prices are dramatically lower in the next 18 months, it doesn't mean we're automatically going to run buy things that are down in price. We think it's still the right approach to be incredibly careful about what's going to happen in the first 6 months of this year. So with that said, I'll wish Brian Curtis, our producer here, Brian, a very happy new year to you and your family, and to our viewers, a very happy new year to you and your families, and we'll do our very best to make sure it's a prosperous year financially. Thank you.